Okay, so here is just our framework for adjusting entries. All right, and in this chapter, we're going to focus on prepaid expenses. That's an expense paid in advance. Unearned revenues. And unearned revenues are revenues that are, well, really it's cash that's received before you provide a good or service. So anytime you collect cash in advance, we need to treat that as an unearned revenue. And then we'll also have accrued expenses and accrued revenues. All right. So the three-step process: determine what the current balance in one of the above referenced accounts is, determine what it should be, and then we'll make an adjusting entry to get to that point. So that's your three-step process for adjusting entries. Okay, so I want to spend the next few slides just talking in the abstract about the types of entries that we will be making. And this particular portion of the lecture, I'll encourage you to listen to it, but also come back to it after we've worked a few problems, because it's going to make more sense. It's going to be abstract for now, and that's okay. So this portion of the lecture is going to be best utilized as you listen to it, get a feel for the terminology. We're going to spend some time working through adjusting entries, come back to it and listen to it again. So that's the way I'll suggest you use that. So when we're dealing with a prepaid expense, one thing to keep in mind with adjusting entries for Chapter 3. When you are making an adjusting entry, that means there's a timing difference between either a revenue and expense and the related cash inflow or outflow. You are always going to adjust for an income statement account, i.e. a revenue or expense, and a balance sheet account, i.e. an asset or a liability. So if you pause when you've made an adjusting entry and say, is one of my accounts a revenue or expense, and is the other of my account an asset or a liability? If the answer to either of those questions is no, then you're wrong, and you want to take a closer look at what you've done. For instance, a prepaid expense is an asset. All right, so you'd have an unadjusted balance. Prepaid expenses expire as time progresses. All right, so the adjusting entry is going to credit that, which reduces the asset, and increase an expense. Now this is just the illustration that we saw with the 24-month insurance policy earlier in this lecture. Unearned revenue. All right. So the thing about unearned revenue is the name is can be confusing because it has revenue in the title, but unearned revenue is not revenue. It is a liability. And the reason an unearned revenue is a liability is because you've already received the cash. The company has already been paid, but they have not yet provided a good or a service. So they have to do that prior to earning the revenue. All right. Cash received in advance of providing the good, product, or service. So you have a liability. It would have a normal credit balance, as liabilities do. And so we're going to debit that when revenue is earned. And of course, revenue is increased with credit. So our credit we would credit revenue. Accrued expenses. All right. So accrued expenses are expenses that haven't yet been paid. This is the example of you get the utility bill at the end of the month and it has not yet been paid. You haven't written a check for it. Well, Accrued expense is a liability, right? Because it hasn't been paid. But, for instance, with the utility bill, the expense has already been incurred. You've already used the energy, the electricity. So you have to record that expense, right? And again, we're keeping with the trend. One income statement account, in this case an expense. One balance sheet account, in this case a liability. Accrued revenues. So in this case, accrued revenues are earned in one period, but the cash is not yet received. All right, so we've actually done this as well. So you're going to increase an asset. It's going to be a receivable. All right, and you're of course going to recognize the revenue because you have provided a good or service. Okay, so this really is just a graphic illustration of what I just said as it relates to adjusting entries, kind of this branching analysis as it relates to the timing difference. So paid cash before expense our revenue is recognized, where you're going to have a prepaid expense or a deferred revenue. All right. Paid or received cash after expense or revenue. So you're going to have accruals in that case. And so these are the adjusting entries. And if this branching analysis helps you, then by all means. Sometimes I find it easier just to recognize patterns in similar accounts because there really are only so many types of adjusting entries that we're responsible for. For instance, prepaids and revenue received in advance of service. Those journal entries are going to look very, very similar from one problem to the next. And so we just need to remember how those work from a conceptual standpoint.